Hi, Dominique, and very warm welcome. Obviously, we converse, every day. But still, Happy New Year! Happy New Year to all our clients, all our kind of viewers every week. I'm speaking for both of us. We're very excited to restart the week ahead, and obviously our discussions and getting your thoughts. And it feels like we probably were right to take a couple of weeks off there. And now it came back to, certainly from a US economic standpoint, was quite a week. And obviously I know we've said quite a week many times over the past year, but often that's from a market standpoint. This is maybe from an economic standpoint, a lot of kind of cross currents that are going on. So first, how are you doing? And obviously Happy New Year.
So Happy New Year, Andrew, and what a wonderful backdrop you have. I'm envious.
I may be overdoing it with the sweater, so that's the only thing. But I'm so sure far, it's with a nice warm island breeze. I feel okay.
I'm sure it's a very light cashmere sweater, that you can wear under the breeze. Yeah, I mean, basically, the big picture is, in my view, definancialization. The ratio of the value of financial asset to GDP is coming down. It's very painful. It just got started last year, and we are in for another year. Though this quarter is actually going to feel as if we were back to the good old Goldilocks times, but I don't think it will last. Shall I start with?
So hey, let me just close the door. So that's interesting in the sense because you've been pretty cautious on risk, and rightly so, for I would say the last 9 months at least, because of this view that you believed, well, two things: one is that inflation wasn't coming down, and two, that the Fed was going to surprise on the hawkish side. And both of those things have been right. And obviously, for both of just those two reasons, it hasn't been great, certainly owning high beta certainly US assets. So now, let's get into your overall view. But it sounds like one of your views is, at least for the next couple of months, we may get a little bit of a Goldilocks kind of. It looks like in the short term, inflation coming down, and yet growth stays fairly strong. And I would say both of those are probably out of consensus, let alone the view together. Maybe a little bit more after this past week. So give us the combination of your overall view and also kind of how you interpreted the Fed minutes and obviously all the data that came out in the last week.
Sure. So inflation is, I think, in remission for a few months. I mean, two things are driving this. So first of all, when inflation is high, and right now it's high, core inflation becomes correlated with energy prices. Energy prices have been falling year on year, largely, I think, because China's oil consumption was flat last year. But I think energy prices are eventually going to make a comeback sometime around the second quarter, and that's where I expect to see a recovery in core inflation. And the other thing, which is fueling perceptions that the world is great, inflation is gone, is something which has puzzled me for a long time, and I think I finally understood. The wage increases we have are totally out of whack with a labor market that is the tightest in 50 years. And the reason is because of firms reacted to the pandemic. So typically when there is a recession, firms hoard labor. What I mean is that they fire people, but they don't fire as many people as they could in order to meet the demand for their whatever it is they are selling. So they do. So they keep labor, more workers than they need, and what they do instead is they reduce hours worked. All this you can see clearly in the
Right, which
data.
is a little bit what's happening now, right?
Well, actually, what happened during the pandemic was the opposite.
No, I
Firms
mean, sorry. I mean, I saw that average hours worked
So
has been coming
I'll,
down
I'll,
recently.
I'll, I'll
Yeah.
come to that in a second.
Uh,
But what happened during the pandemic is firms got so freaked out, or for whatever reason, they fired everybody. And you know that in the US, it's super easy to fire.
yeah.
So I'm not sure this applies to the rest of the world. And then, of course, when the recovery came, they didn't have enough workers. They couldn't hire them, certainly not at the wages they were offering. So they raised hours. So we had something very, very strange, which was in the middle of a downturn, a big increase in hours worked. And that's because of this self-created workers shortage. And so as part of this increase in hours work, there was a big increase in overtime work that by law in the US has to be paid 50% above normal wages. And so what happens is that now, 3 years in, I mean, firms have finally been able to get the workers they need. Hours worked are going back to normal, to pre-pandemic. And so the reliance on overtime work is going down. And you can see that in the data for the manufacturing sector. And so what happens is that the wage index that is published with the NFP, which is an average wage, takes into account overtime work. And so the decline in overtime work is bringing down average wage. But if you look at median wage indicators, for instance, the Atlanta Fed, it's still going up, because
Okay, I understand.
By overtime.
If you include a bunch of hours where somebody's getting paid 50% more than they would normally get paid, of course, the number is going to look bigger.
Exactly. And so how long is this wage suppression, wage data suppression going to last? I think for as long as firms continue to adjust, on average, hours worked in the services sector are still a bit above pre-pandemic. So I think it could be another quarter or so where we have this wage suppression, but it's not going to last forever. And sometime in the second quarter, surprise, surprise, given how taut the labor market is, we're going to see a recovery in wage growth. Anyways, that's my prediction.
It was small, but the labor participation, I think I saw went up slightly. Is that anything interesting or no?
Well, not really. I mean, it is obviously everything is interesting, but I hope readers will have a look at my summary, because there is a chart that says it all. It's basically the growth, the year-on-year growth in labor demand and labor supply. And of course, labor supply is participation times the working age population, which is set by demographics. And you can see that both are trending down. Labor supply is currently about 1.5%. It's trending down to its pre-pandemic level of 1%. And labor demand is also slowing, but very, very slowly, and remains far above labor supply. So the 20 bips increase in participation is better than, a 20 bip decrease. In terms of big picture, it still is that we are going back after a sort of post-pandemic recovery. We are going back to pre-pandemic trends, and we have these millions of workers missing. Either they died because of COVID, or they've decided that at the wages currently on offer, it's not worth going back to work, and that's not going to change.
So two of the questions, just so I don't forget. One, is it true that the labor participation from 18 to 50 is actually back to pre-pandemic levels, and it's above 50, it's actually older people that have not re-entered the workforce, or much, much slower than the rest? And that's actually, if you take out all these people that are 50, 60, 70 years old that were working before, and they just either have more money or they've been able to save or they've whatever made a lifestyle choice. Do you agree with that on the numbers?
That's the numbers shows that the decline has been the strongest for this age group. Essentially for the reason you just said, those people have alternative source of income, retirement, and so at wages.
They may not be coming back at all. Yeah. Oh, the other one I wanted to ask, and this may be, if you just read the newspaper or listen to CNBC, but I think it's true that the economy is probably losing jobs. People are getting laid off in, let's say, the tech sector, the finance sector. And then the jobs are getting hired in more of the kind of services sectors. Naturally, on a whole, those two sectors per employee are probably getting paid fairly significantly different levels, say price per hour.
Yeah.
If tech and finance people, if they on average get paid much more and they're getting let go, and the people who are more in the service sector are getting paid less and they're getting hired, does that also mess with the numbers or no?
A little bit, but it's not that big a deal. I know that for us, it's hard to imagine that there is life outside of finance and tech, but as a share of the workforce.
You're in California, of course.
Yeah.
I'm in London, so yeah,
exactly,
between the two.
Exactly, that's totally. No, seriously, I think the perception of CNBC and other media outlet is a bit warped, understandably so, because we are their constituency, so they have to publish.
They're going to talk about what they think people want to hear, or
exactly,
or what they react to. So,
but Andrew, there was a development last week, which is actually very good for workers across the board. The FTC wants to end non-compete. And some clients actually reach out to me to ask me, what was a realistic perspective. So there are a lot of people who could do better in tech and finance.
Yeah. And I think your view is a little bit out of consensus. From the Bloomberg chats I saw, people are like, yeah, but this is never going to pass. And your view is you're not so sure. You think maybe there is a chance.
So first of all, some states already don't have non-compete, like California, for instance. Second, politicians want to get elected. And I think one of the lessons the administration got from the midterm is that if you do something your constituents want, like putting a cap on the drug prices or finding ways for people to pay somewhat less exorbitant prices than they are, people will vote for you. Now, who are the constituents of the Democrats? The educated middle classes. Will they like an end to non-compete? Oh, yes. So I wouldn't be overly pessimistic. I think public support is going to be overwhelming for this one. Okay. Let's see.
Anything else that people should take away from speeches, from data from last week?
Let's go through it, starting with the Fed. The Fed, to my surprise, turned out much more attuned to the risk of a positive growth surprise than I was expecting. All along, I had been expecting growth to accelerate, largely due to the end of the fiscal consolidation we just discussed, but also the dollar has peaked, and consumer credit is going gangbusters. So there were strong macro reason to expect growth to actually accelerate. And if you look at the hard data, same thing. The only thing that's negative is the survey data. We can talk, I'll discuss this in a second. But I thought, given that the administration has stuffed the board with Uber dogs, I thought the Fed would completely ignore those risks. And to my surprise, in the minutes, they talked about the risk, the upside risk to growth, and their concern that financial conditions are too loose, tightening is not being transmitted to the economy. And that was a consensus. So, I thought this was, another very dovish Fed. but maybe it's not. It's not quite a Volcker Fed, but it's not an Uber dovish Fed either. So this one is.
Can I ask one quick question? If one of your views, which has been right, is the stock market's not necessarily the economy. And even if you see stocks going down, not that many people have hold stocks are really going to change behavior. But since that Fed meeting, the equity market has come off quite a bit in the US. So even if it doesn't affect that many people, it is a key part of financial conditions, right? It's one of the key parts of financial conditions. Is it because a weak stock market affects credit or high yield, which affects bank lending standards? Like what is the two different things?
So the channel from the stock market are basically wealth effect and credit worthiness, so the value of collateral, as you said. But again, if you look at the data, you can see that since the great financial crisis, the wealth effect is nowhere as strong. Before the GFC, wealth went up, people saved less. Since the GFC, people have been saving irrespective of the wealth effect. And there's been a big decline in the savings rate, but that had, since the pandemic, that had nothing to do with the stock market. It was all about the administration, the Biden administration, coming up with this insane stimulus package when the pandemic was over.
But what's your view on bank lending standards right now?
So bank lending standards are tightening a bit. If you look at the Fed survey, also it would make sense given that the Fed, somehow, to my surprise, is less optimistic than the market on its own policy inflation. Bank supervisors have probably been told to tell their banks to pull their horns in a bit. But again, if you look at the data, and I hope our listeners will look at my charts, my two forthcoming notes, you can see that credit growth.
Yes, obviously it's a good plug for people to be signing up for certainly the full set of information, and even access to you as through a professional, and for a lot of some more of your pieces though, people can also access through Prime, both of which you can. Prime you can access and sign up through the website, and professional, obviously you could reach out to one of us, and if it's on Bloomberg, we can, or email one of us and to get more information. Sorry, go ahead.
No, I was going to say one of my core view since the beginning of this tightening campaign has been the Fed is pumping the brakes, but the US economy is not slowing because of structural changes and recent policy development. The US economy has become more immune to monetary tightening. So I don't want to spend too much time discussing it. It's one of my core views. I stick to it, and I think it's going to be a bigger issue for the Fed when we see the recovery in inflation sometimes around mid-year.
Yeah. Last one on that, and then we'll go to the week ahead. I seem to remember that Jamie Dimon's view was the U.S. consumer is still in good shape, but by the numbers they look at, they are basically taking on credit or debt, and that surplus of savings that they had, most of that will be depleted by mid next year. If wages don't keep up with inflation and inflation stays relatively high. And from then on, which is kind of contrary to a lot of people's view, which is maybe things are bad now, but then they'll get better in the second half. What do you think of that? What Jamie Dimon's, assuming that that's generally his view?
Well, Jamie should look at my charts. I'm joking. But that's another of my core view, again, in this note, which is coming out on Monday. One key indicator I look at very closely is real household income without government transfers. And the reason I like it is that it gives you a good sense of the sustainability of growth without any form of government support. And also turning points actually can tend to be fairly good leading indicators of recession and expansion. And right now, this indicator is troughing. So what I think is going on is that we are at a turning point where, because demand is strong, firms are able to hire workers, which in turn generates more demand, and so stronger hiring. So it could be that reliance on credit becomes less important as we see takeoff in this real household income.
Okay, cool. Anything else from last week or?
So the freakish PMI, services PMI, which really threw me off because I kind of believe in data. And so when we get such a large surprise, negative surprise, and one which I didn't expect, that really has me thinking, look at my data. And I'll just say this, it's all, I mean, look, I live in LA. It's the second largest city in the US. Even though I spend all of my time working for our clients, I still go out and look at the shop. We are not there is no recession in LA. So I think this number is really freakish. In fact, in one of my notes, I have a couple of scatter plots showing that the relationship between surveys and hard numbers has completely.
I remember you saying that. And part of your thought is because of inflation, that people just feel worse, or businesses feel worse, or and that was kind of what. But services was the one thing that was hanging in there. Well, looking through the numbers, what was the big driver? And I think. The other thing that people, I think, got freaked out was it like new orders or something like that really fell off?
Yeah, but I'm not seeing that in the hard data. So I don't believe it. Basically, I'll keep it, I know it's there. I'm not ignoring it. Yeah. But again, so as you say, there is inflation. There is also, I think there was also an extraordinary increase in uncertainty at the beginning of the pandemic, and then an extraordinary recovery. And I'm thinking here about the economic policy uncertainty index. One thing a data point I'd like to mention is a disconnect between how people see the direction of the country in the US, where like 75% think it's headed in a wrong direction. But when people are asked about their life, 80% think it's headed in the right direction. So God knows. And then there is a partisan split between respondents to the surveys, for instance, the Michigan consumer survey. I don't know what is going on, but I know that the data has become a lot more noisy. And because it's noisier than the actually hard number, I'm going to pay less attention.
Look at it next. Okay. Okay, awesome. And probably a bit longer than we normally do, but obviously we had a lot to cover, and there was a lot of information this past week. So key data for this upcoming week, and you had a consensus on any of it?
No, that's all. The CPI is key, and I think it's going to be in line with consensus for the reasons I just explained. Yep. Jobless claim still very low. Consumer credit, I think, maybe a potential for a surprise, but what the consensus expects is consistent with strong growth. Budget statement, we already discussed it.
So consumer credit, silly, I think I've asked you this before.
No, that's all.
What would surprise the market in a bad way if that number was much higher or much lower?
Much higher. But to be honest, I don't think the market is paying much attention to consumer.
Okay, fine.
To me, it's key to my growth story, but frankly, I doubt it's on the radar screen. And then we have small business survey and the University of Michigan consumer confidence. But to be honest, these have such a very vague relationship with what's going on in the world. I wouldn't pay too much attention to those. What is important actually is actually not the data, but whether now that we have a Speaker of the House whether Secretary Yellen sends a letter to remind him and to Senator Schumer
Kevin
as well
McCarthy, yeah.
that we are close to hitting the ceiling on the debt, and it's time to think about a raise.
But has something been agreed already? I thought
No,
it's already been agreed,
no.
and yes, the numbers look big and some big increases there. What's been agreed or hasn't?
So nothing has been agreed. The Democrats had a few weeks where to pass legislation before the House became Republican, and they decided to pass a budget rather than raising the debt ceiling. And I think the calculation here is that if the Republicans make a fuss, they will lose votes. They will go down in the polls, which, based on what happened with the election of Speaker McCarthy, with a few, basically McCarthy's position is very much like the position of the Democrat in the Senate. The Democrat in the Senate have had a majority of one with the vice president, because the Senate was evenly divided. Now they have a majority of 2 because they have 51 Senate seats plus a vice president, but it still leaves them exposed to the demands of the centrist Democrats, so Senator Manchin and Senator Sinema. And now we have exactly the same in the House, but with a Republican, where
the problem is it's the other way. I think a lot of the country was like probably happy that Manchin was there. Yeah. But I'm not sure a lot of the country's happy that Matt Gaetz is there.
So, no, definitely. And that's the calculation of the Democrats when they decided not to raise that ceiling, when they had the majority in both chambers. And they are basically giving the Republicans enough rope to hang themselves. So it's probably going to be, the usual theatrics with everybody claiming that the Republic is in peril and all that. But they will raise. Will they be able to impose, some changes to the budget? Maybe. But if they do,
like I was reading that they were some of this MAGA, the people that are holding out, whatever the 12 Republican congressmen, and they wanted to have a significant cut to defense spending, which seems strange. Why would they want that? Or is that just like they were putting that in to threaten or something? Or
No. It's actually a very interesting policy debate within the Republicans. Actually, it's a debate that was opened by Trump. Within the Republican Party, you have the populist wing that wants to spend less on the military and more on the US. And so it will be interesting to see how that works out.
And it could also be this Russian-Ukrainian angle, like the perceived, but it's a defense spending now is a long game. From my understanding, one is the spending and replenishing a lot of maybe some of even the equipment, but a lot of it is just somehow hopefully trying to reorganize the whole process, because there's just so much red tape that it's like impossible to get new weapons or open it up to more competition, and it's gotten worse in the past years. I don't know this. I had read this somewhere. So
yeah, no, definitely. I mean, it's a real issue. The procurement system is broken, and the US spends, what is it? So in terms of GDP, it's 3.5%. It's 3.5%. But in terms of actual levels, because the US is largest in the world, it's like 10 times the next country, and it gets very little value for all its money, in part because the procurement system is broken. I would also add that for the past 3 years, the Pentagon, the Department of Defense, has not been able to pass an audit of its expenditure. Those guys have so much money, they have no idea where it's getting spent. So for sure, there is a need for reform, which would be very good for all involved.
Yeah.
But we have such an acrimonious political process. I'm not sure we'll get anything productive out of it.
Fine. But in general, this, especially in today's world, I mean, maybe passing big package isn't great, but the general view is if there's if there's lack of compromise in Washington, that usually means lower spending, and less things getting done. Has what's happened the last week better or worse, you think, for the markets?
So I think the elections were positive for the market for the reasons you describe. More Republicans typically means less spending and fewer taxes and fewer regulation. What happened with the election of McCarthy just shows that policy paralysis is even more likely than we thought. So
even more now, so more likely, not less likely.
Yeah, more
Right.
likely, definitely, because of these extremists who happen to
Who
have.
are never going to want to make a deal with Democrats. Yeah. And last question, I saw in one of our chats, somebody brought up the point. Could Democrats have voted to support McCarthy and gotten him the votes he needed, or wasn't a possibility?
I mean, the Democrats are gearing up for 2024, so they want the Republicans to show themselves as incompetent as possible. And so, from that perspective, I think they were quite happy with last week. Right.
Okay. Awesome. Okay. Then just a quick recap as we kicked off the year. I guess first for some pieces for our prime customers and probably even light customers, but certainly free. The whole pieces is two great pieces on crypto, impact on the dollar, kind of impact across different indices or kind of sectors within crypto, which was some great pieces by Dalvir and Bilal. John Tierney wrote a really interesting piece, which I think very much fits in with your view, again, this would be at a consensus, is that he doesn't, if you hear all the kind of last earnings calls and you go through the earnings calls, there really was not that many mentions of recessions from public companies. So this whole giant fear about recessions isn't really coming from CFOs and CEOs, at least for now. So he's a Eurocamp, and I think pretty constructive, certainly on growth. And then on the professional side, so that's for the most sophisticated financial investors, Bilal's kind of expanded on something that he's been kind of looking into deeply and trying to understand what the secondary effects are, which is a big repricing of private assets and the effect on private equity. And that's a super cool analysis. And I think he's actually going to talk to a few classes and faculty at Harvard this coming week, which should be interesting. So that was in his macroscope. China Growth Tracker, which has always been interesting for the past couple of years. We've done it now more than ever. It looks at kind of, as you like to say, the combination of hard and soft data, and it's kind of dovetails into our view and kind of Bert's view. Actually, Chinese assets and the currency continue to do well. And that's been, by the way, a fantastic call, and definitely was out of consensus, I think, at the time. And then I saw Bilal's Rates Weekly, where he focused on the BOJ and the potential moving or expanding again of the YCC and another YCC adjustment, which it feels like that's coming down the pipe quite soon. And he breaks into in real data-backed analysis of why. I don't know, anything else you want to add, and we'll let everyone.
No, that's quite a lot to digest for a first week, but I think it's just shows what the year is going to be like. So just wanted to say again, Happy New Year, good luck on the market, and please send feedback, especially if you disagree.
Yeah, absolutely. Awesome. Okay, cool. Well, Everyone enjoy the rest of your weekend or upcoming week. Dominique, of course, enjoy the rest of your weekend, and good luck, everyone.